This is the Asia Trade. I'm Paul Allen in Sydney, where markets have just opened. Now, top stories. A strong lead-in for Asian stocks, with Wall Street notching one of its best sessions of the year. Risk appetite getting a boost from signs US trade sanctions will be narrower than feared. President Trump, though, warning tariffs on imported cars are coming in the next few days ahead of his April 2 reciprocal duties. And we're live at HSBC's Global Investment Summit in Hong Kong. We'll be speaking exclusively to ARK Invest CEO and CIO Cathie. All right, let's get a check on how markets are tracking. We have just opened for trade here in Australia. Of course, it is a staggered open, so hard to get a read on things in the early going. We're seeing some modest upside there, and modest upside is also what we saw on Monday here in Australia. Just the ASX higher by a few points there. Nikkei futures showing a little bit of softness at the moment. We do get Bank of Japan minutes from its January meeting today. Might give us a little bit more insight into BOJ thinking. We've also got the yen right now back above that 150 level, and not a lot of change there for the Chinese yuan. It was a pretty good day for US stocks, however. We saw a pretty powerful rally, particularly for tech names. The Nasdaq was up 2.2%. The Mag 7 had its best day in about 2 months. And we also had President Trump signaling a more nuanced approach to that big tariff announcement coming on April the 2nd, so-called Liberation Day. There might be some reciprocal relief, so that saw a bit of a tailwind for US stocks, but we're seeing futures looking a little bit softer at the moment. The oil price, one to watch as well, climbing a little bit. The US also announcing it's going to be placing a 25% tariff on any country bringing in Venezuelan oil and gas. Now, more details on that also coming on the 2nd of April, but that could impact China as well. So, yeah, a little bit of volatility to watch in the oil space going forward. Well, let's get a bit more on those tariff plans. President Trump saying he's going to announce tariffs on vehicle imports in the coming days, while indicating that some countries will receive breaks from next week's reciprocal tariffs. For more on this, let's get to Bloomberg senior editor Derek Wallbank. So, Derek, in terms of these potential reciprocal breaks, what could be on the table here, and which countries might get a bit of relief?
Well, what a big question that turns out to be. Look, I think we've talked a lot, right, over the last couple of weeks about the difference between what Donald Trump has threatened at its most maximal levels, as well as what winds up actually getting done. There's a certain arbitrage opportunity within those, as you saw markets reacting there. Now, Trump has said that he's going to announce tariffs on these automobile imports in the coming days. We've been looking for that as details of where those are going. Trump has pushed for automobile manufacturers to move production into the United States to do that. But at the same time, he did, as you mentioned, note that there are going to be opportunities for countries to sort of figure ways around some of the tariff packages and open things for negotiations. We've seen a lot of countries trying to do this already. Speaking to in our local area, right? Australia is one of those key partners. The Albanese government has been very keen to try and figure out ways that it can get around some of the tariffs that have been mentioned there. Haven't found quite so much success so far, but it is a critical question that all of these countries are figuring out, because as Trump is going through and saying that there may be ways around, he is not necessarily giving countries a full roadmap on how exactly to do that, what is the package of deals that may be necessary to do so, but he has indicated that such things are possible, and you're seeing a range of reactions and strategies for how to do that, from a very sort of soft, non-confrontational tone that Mexico has taken, to a very sort of ice hockey-inspired elbows-up response that Canada has taken.
Let's talk a little bit about these potential oil tariffs as well. Secondary tariffs on any country, 25% that's importing oil from Venezuela. What's the reasoning behind this, and which countries could feel the most impact potentially?
Well, again, great question. We just had some breaking news before we just started here, which was that the Trump administration has released an executive order on this. Now, we're still going through the details of this. I've had a quick look at it. It does appear, as written, to have a little bit of wiggle room in it, a little bit of discretion, so it may not be every single country that imports Venezuelan oil, either directly or indirectly. Of course, it should be mentioned mention the United States as an importer of these products, but obviously there's probably not a mechanism to tariff itself. This order, as I say, does give the State Department a little bit of wiggle room in terms of figuring out who would get this. But what Trump is talking about here is a 25% secondary tariff. That would be a tariff on top of anything else that is already promised, threatened, implemented. So a secondary addition. Think of this almost as a tariff version of sanctions, if you will. So a little bit of a novel kind of theory of the case that you see the administration rolling out. This is going to come on April 2nd is the first day that these could go into effect. So that's something to watch for. One nugget in that executive order that stood out particularly to me is that this one continues a trend that the U.S. has been doing of ensuring that everyone knows that if a decision is made on China, it would affect Hong Kong and Macau as well. No differentiation in the special administrative regions.
All right, Bloomberg senior editor Derek Woolbank there. Well, Atlanta Fed President Rahul Bostic now expects just one rate cut this year instead of two. He told us exclusively that it's unclear whether tariffs will be a one-time hit to prices. But President Trump's top economic advisor has played down the idea of short-term damage to the U.S. economy.
I don't think that there's going to be material short-term pain from the tariffs. I think the short-term pain is coming from the reorientation of the economy from the government to the private sector. Now, of course, as you know, the tariff situation is still developing.
I was at 2, I moved to 1, mainly because I think we're going to see inflation be very bumpy and not move dramatically and in a clear way to the 2% target. Because that's being pushed back, I think the appropriate path for policy is also going to have to be pushed back in getting us to that neutral level.
Well, let's get some more perspective now on markets with our next guest. Rahul Chadha is founder and CIO at Shikhara Capital. Joins us right here in Sydney. So, Rahul, thanks for joining us today. Just want to start with those remarks from Rahul Bostic there, potentially just one rate cut now in 2025. What's your outlook for what the Fed's going to do this year?
Yeah, Paul, I think those projections seem to be moving. I mean, if you look at 6 months back, there was almost one towards the end of the year. A couple of weeks back, it was 2 or 3 beginning June, and I think as the tariffs get a lot clearer, and our sense is the tariffs are going to be a lot more narrower in scope, a lot more moderated, I think the rate cuts would be much higher than one. Our sense is still 2 or 3. Yep.
And in terms of the impact of tariffs, I mean, everyone's got an opinion on this. Are they inflationary? Are they not inflationary? Is it a one-time hit? What's your view on the impact?
So the sense is here that, look, unlike 2018, where US had a deflation issue, right now inflation is one of the biggest concerns, which is why the incumbent government, the Democrats, were voted out. And we've seen that in recent weeks with the current Trump administration also. They've been far more discerning about implementing the tariffs. So there's been a lot of noise, a lot of escalation to de-escalate, but you've not seen large-scale tariffs being implemented, basically.
In the terms of some reciprocal relief and maybe some carve-outs for some of the more cooperative countries, look, the markets took some comfort in that.
Absolutely. Yeah. So if you look at it, I think what is going to be is buy more US oil, buy more US kind of a defense equipment and other thing, etc. Probably buy more treasuries at low interest rates or zero coupon, etc. So I think that's the way, or probably invest in US pretty much like the Plaza Accord of 1985. I think that is going to be the way out, but the space evolves in the coming quarters.
So is that your approach to US markets? Just buy more, full stop?
Yeah. So I think the way we are looking at this is our view is US kind of goes through this period of detox, 2-3 years of course correction. Look, coming out of COVID, most other countries cut back on the fiscal spends. They've kind of curtailed their fiscal deficit, but for US, where fiscal deficit is about 8%, the trade deficit is exceptionally high. And to fix all these structural issues, these issues cannot be fixed in a quarter or two. They require 2-3 years, and most investors were overexposed to US, whereas as you come to, again, emerging markets, China is doing all the right things from June of last year. They're giving the consumption stimulus. They're taking care of the local government issues. India has gone through this cyclical downturn, which kind of impacted the economy last year, so things should improve.
I want to come back to the China-India story a little bit later, but if we can just look at the US for the moment and get to our Bloomberg question of the day. Do you think it's going to be not too long before we see the S&P 500 notch a new record?
I think it's going to bounce around these levels. So you see, the market is not cheap. It's kind of most people are overexposed. So what we're seeing in US is kind of a sell-on rise for at least this year. And what we're seeing in some of these Asian markets is they are buy on dip. So you continue to see China, India touching new highs, where the US is going to jump around these levels.
All right, Rahul Chadha, founder and CIO at Shikhara Capital, going to be staying with us. We will talk a little bit about China next. Also coming up on the Asia trades, a Bloomberg scoop. Xiaomi looking to raise about $5.5 billion in an upsized share sale as it invests aggressively in its EV business. Also ahead, Newton Investment Management going to tell us why the dollar could be suffering from a positioning squeeze. We're going to head to the HSBC Global Investment Summit and talk to ARC's Cathie Wood. We'll also discuss Australia's defence spending plans ahead of tonight's budget. This is Bloomberg. It's shaping up to be a bumper year for share sales in Hong Kong. Bloomberg's learned that Xiaomi is set to raise about $5.5 billion in an upsized share sale to help expand its electric vehicle business. The offering comes just weeks after EV giant BYD raised $5.6 billion. So for more, let's bring in our China correspondent, Min Lo. So Min, tell us a little bit more about this share sale. What's the plan and what's Xiaomi going to use the money for?
So according to the terms of the deal that Bloomberg has seen, Xiaomi was initially planning to sell 750 million shares, but sources have told us that Xiaomi plans to raise that to 800 million shares, selling at about 553 Hong Kong dollars a piece, which is slightly below the midpoint of the marketed price range. The company plans to use these funds to invest in R&D and to drive their drive their expansion as well. And this company, obviously, they're taking advantage of their share price, as you can see on the screen. It's actually flipped nearly 3 times over the past year or so, and investors like that this company has been able to replicate its success in the smartphone business in the crowded EV sector as well. Xiaomi has invested heavily into its EV arm. It's raised the delivery target this year after posting the highest revenue since 2021. It's planning to expand the scale of this second factory planned for Beijing to ramp up production. So very strong prospect for this company. And what this means for Hong Kong as well is that it could raise the overall share sales volume for Hong Kong to the highest this quarter since late 2021. And part of it is because the Hang Seng has been outperforming global indices, and that's drawn a lot of investors' interest and hopefully revive this deal pipeline as well as more companies tap on the equity markets for funding.
Let's talk about those BYD numbers as well, those sales topping Tesla for the first time. What's the car maker saying about what's next and which markets is it looking to expand into?
Yeah, so BYD managed to hit that milestone of $100 billion in revenue. As you said, leapfrogging Tesla. Its revenue came in at 29% growth on year, beating estimates. Net income grew by 34% on year, also beating estimates. But here's where it has fallen short of Tesla. It's the profits. Tesla still makes more profits than BYD, and that's where BYD's aggressive pricing strategy has an impact on its bottom line. But still, very aggressive targets this year for BYD. It's estimating that it could sell 5 to 6 million cars this year, up from 4.2 million last year. And it's already made good inroads in the first 2 months of the year, where sales was up about 93% year on year. And the company's chair said that the company will still continue to focus on R&D and to improve the company's competitiveness overseas. We know that it doesn't really have a market in US because of those tariffs, but it has made inroads into Europe and parts of Asia like Thailand, Singapore as well.
All right, Bloomberg's China correspondent Min Lo there. Let's get back to Rahul Chadha, founder and CIO at Shikhara Capital. Rahul, you were mentioning a little bit earlier that you are overweight China, you like China. How do you feel about the car makers? You buying BYD, Xiaomi?
Yep, no, we've invested in these car makers, and even when we were positioned in China prior to this rally, our view was the global champions coming out of China, the likes of BYD, Xiaomi, Pinduoduo, Strip.com are super attractive because these names were trading at at almost 50% discount to the global, the US peers, etc. And one could sense the product quality was getting significantly better than their international peers, and they were gaining traction in the global market. So I think that is going to be an interesting story for years to come, these new global champions from China, basically.
Obviously, though, China in the crosshairs of the US vis-a-vis trade policy, but we've heard from the government saying it's preserving fiscal power for any impact. How do you see this trade battle between China and the US shaping up?
So I think unlike 2018, where China was caught by surprise, China has been a lot more prepared this time around. If we see a lot of Chinese exporters who export to the US over the last 5 years have moved to ASEAN countries, have moved to Mexico. More importantly, I think the market's kind of pricing in this trade war. And what is happening also is over the last 6-9 months, the leadership in China is doing all the right things in terms of taking care of the local government debt issues, taking care of the real estate bubble, and then in a very targeted way giving the consumption stimulus. So they're then keeping their gunpowder dry, at the same time making sure the business and the consumer confidence comes back, basically.
Do you feel this rally that we've seen in China, though, feels a little bit uneven? Because if we take a look at the Hang Seng, it's done amazingly well. It's up something like 19% on year, while the CSI 300's looking pretty flat. Do you have any concerns about the confidence of retail investors in China and consumers as well?
I think what happened prior to this rally was a lot of the locals were kind of positioned in CSI 300 because their idea was this is relatively insulated from the foreign selling. And if you look at HSCI, the valuations are very, very attractive. So and bulk of these consumer platforms, the internet platforms, are in HSCI. So when the foreigners returned, it was bound to re-rate much better than the CSI. So no specific issues with the outperformance HSCI has. I think the companies there are great. The valuations were attractive. It was under-owned. And you look at the inflows from the southbound. The inflows, YTD has been record, basically. If I'm not mistaken, more than $150 billion.
I want to talk to you about India as well, because you're also bullish on the outlook here. We did see some pretty heavy selling for the Nifty towards the end of the year, but the last 6 days, it's really started to see that turn around. Do you feel that that's sustainable?
Absolutely. So our view was somewhere around mid-Feb that India's bottom. See, what happened in India was, again, in H2 of last year, you had RBI, which was tightening. Again, there was a forex reserve drawdown of about $60 to $80 billion. Domestic liquidity was tight. RBI was worried about the unsecured lending. Look, government had run out of this, all these infrastructure projects. So all that kind of turns better now. What we've seen, YTD, is RBI's cut rate by 25 bips. We've seen government give some bit of a fiscal handouts, $12 to $13 billion to the people, and the economy is kind of a bottom and is improving Q&K. And India is a structural story. See, something we've got to understand is, with whatever China is doing, growth is not going to be beyond 3 to 4%. So you've got to buy market share gainers in China. You've got to buy global champions in China. But India is a story of 9 to 10% nominal GDP. And when a $3.5 trillion economy grows at that creates a whole bunch of opportunities.
All right, Rahul, thanks so much for coming in today and sharing your insights. We're out of time, though. Thank you. That's Rahul Chadha, founder and CIO at Shikhara Capital. We have more ahead on the Asia Trade. This is Bloomberg. Welcome back. Here are some of the top corporate stories that we're tracking today. Hyundai has announced plans to invest almost $6 billion in American manufacturing, including a new steel plant in Louisiana. The company also says it plans to spend about $21 billion in the US through 2028 to increase vehicle production, confirming earlier reporting by Bloomberg. President Trump hailed Hyundai's plan, saying it's a clear sign that tariffs work. Boeing reportedly wants to withdraw from a deal with US prosecutors to plead guilty to misleading regulators before the 2 deadly crashes of its 737 MAX aircraft. The Wall Street Journal says the plane maker is seeking potential leniency from the Trump administration, which is reviewing many pending white-collar criminal cases. OpenAI is expanding the role of its chief operating officer, Brad Lightcap. He'll now oversee day-to-day operations, including international expansion and partnerships with firms such as Microsoft and Apple. OpenAI CEO Sam Altman's shifting his focus to the technical side, including guiding research and product efforts. Meanwhile, in an effort to rival the ChatGPT maker's dominance in generative AI, Google is reshaping its search engine. However, as the company's leadership embraces chat-based searches, Google's struggle to translate AI breakthroughs into substantial consumer products persists. Well, let's bring in Bloomberg technology reporter Julia Love. Julia, why has it been so hard for Google to incorporate generative AI into search?
So this really hits on some existential questions for Google. They invented many of these breakthroughs in generative AI, but it has been really tough for them to fundamentally reinvent their core product, Google Search. To really roll out generative AI in search would potentially mean disrupting the ad business. And so that has kept them moving more slowly. And with our story, we documented some attempts that were made internally to launch this technology in search well before the launch of ChatGPT, but there was just a real cultural resistance to shaking things up at that time.
So how's the response to OpenAI been going so far?
It has been a bit bumpy. Google rolled out AI overviews in the middle of last year. The product was delivering some faulty advice to users, telling people to eat rocks and put glue on pizza. And I think that Google is just held to a different standard. When ChatGPT hallucinates, people kind of view that product as a bit more of a novelty, and Google Search has become a core utility in all of our lives.
All right, Bloomberg technology reporter Julia Love there. And subscribers can read more about Google embracing AI in today's Big Take, and that's available on the terminal and on Bloomberg.com. All right, let's check in on US futures. Looking a little bit softer at the moment after what was a pretty strong day on US markets. We've got S&P E-minis off by just 5 points at the moment, although we did see stocks rally pretty hard in the US session. The Nasdaq up 2.2%, Mag 7 having its best day in about 2 months. And we've got Dow futures looking kind of flat at the moment. The reason for today's rally, though, of course, we have President Trump signalling a more nuanced approach to Liberation Day tariffs. That's April the 2nd, signaling that there could be some reciprocal relief for a number of countries. We did see factory activity, though, slipping back into contraction in the US for the month of March. And yeah, you guessed it, that's due to a tariff-related rise in raw material costs. Let's take a look at how we're tracking here in Australia. Meanwhile, we've been up and running now for just coming up to 27 minutes, and we have actually that's not on the board there, so I'll tell you about FX instead. We've got the yen softening a little, now at 150.81. We're going to get minutes from the Bank of Japan a bit later from the January meeting. However, they're always a little bit slow to make an appearance. Not a great deal of change for the Aussie dollar there, just softening ever so slightly against the greenback. Big day in Australia, of course. We do have the budget being handed down later on this evening, so that's in, let's say, about 9 hours' time. And that budget will, of course, be foreshadowing an election, which is yet to be called, but we know that it's going to happen before May the 22nd. All right, we have more ahead on the Asia trade. Do stay with us. This is Bloomberg. You're watching the Asia trade. Here's a look at how the Aussie dollar is doing, just still hovering below that 63-cent US level. We are, of course, awaiting this evening's budget. Treasurer Jim Chalmers set to unveil that annual budget in Canberra tonight, Tuesday night. Economists expecting a small revenue upgrade with an underlying cash deficit slightly better than predicted. Government reporter Ben Westcott joins us now with more. So, Ben, we've had a couple of surpluses out of the bag from this government that we didn't really expect, but is that the end of the line?
Well, for the moment, certainly. I think the government is at the moment saying that they are not expecting any budget surpluses. Well, they're not effectively saying when we would expect the budget to go back into surplus. Part of that is probably because they want a bit of leniency when it comes to this. Part of it is because the first two surpluses, I mean, it's fair to say, didn't help them economically. Didn't help them politically a huge amount. Obviously, they were, for a long time, a surplus was the gold standard of budget management in Australia. But certainly in recent years, despite getting those two surpluses, there's been a lot of criticism of the government's budget strategy. So now going forward, I think they're looking more at small deficits rather than anything else.
And of course, this year's budget coming earlier than usual because it's setting us up for an election probably in May. And how are they going to balance these questions over cost of living on the one hand with probably a need to increase defence spending on the other?
Yes, well, I think it's going to be a really delicate balance for the government because they still can't afford to increase spending too much and risk inflation going through the roof again. Because, even though they are planning for the election, they are also looking at potentially a second term in office, which would then mean that there was a giant jump in inflation later in the year, partly as a result of their spending and partly as a result of global factors. Then that would be really bad for their government. But what they're looking to do at this point is they are sort of throwing the guardrails aside just a little bit, opening it wider than they have in previous years to make sure they can fit in some of that spending that they need, particularly on things like healthcare, which is going to be one of their biggest ones. There's not going to be, we think, too much new spending on defence in this budget. It'll be more a highlighting of what they've previously done on defence, just as a result of the fact that they haven't really got huge mountains of cash to splash around.
All right, Australian government reporter Ben Westcott there with a busy night ahead of the budget. And you can join us tomorrow. We'll have a full debrief of the Australian budget. Finance Minister Cathie Gallagher is going to be with us live, 7:15 a.m. Hong Kong time. Also, Shadow Treasurer Angus Taylor is going to give us the opposition's response about an hour after that. And we'll have more scrutiny of Australia's budget and defence spending plans coming up in the next hour. We'll be joined by the Australian National University's Jennifer Parker. Well, Atlanta Fed President Raphael Bostic says he now sees just one interest rate cut this year rather than two, and that's due to tariff hikes impeding progress on disinflation. Speaking exclusively to Bloomberg, Bostic also says the big question is how consumers will react to higher prices.
My projection of where inflation is going to go this year is pretty much sideways, and we won't get back to a more neutral level of inflation, our 2% target, I don't project until sometime early in 2027. But it is very much hearing people take in the latest news, figure out what that means for them, and then I will respond to that in terms of how I think about the economy's trajectory and policy.
Last month you said you thought that we would have 2 rate cuts this year. The dot plot didn't change, still calling for 2 rate cuts, but a number of people moved their dots up to say maybe we get fewer than that. Were you one of those?
I was one of those. So I was at 2, I moved to 1, mainly because I think we're going to see inflation be very bumpy and not move dramatically and in a clear way to the 2% target. Because that's being pushed back, I think the appropriate path for policy is also going to have to be pushed back in getting us to that neutral level.
Well, some of your colleagues also moved their dots down, suggesting that we might see more rate cuts, probably because they think the economy will weaken. What do you think the odds of an economy weakening because of fiscal policies are?
Well, what I would say is I am hearing more concerns about the trajectory of the economy. That's undoubted. But what I also will say is the data that's come in to date has not actually shown that, and we've still seen a resilient economy. I do know that consumer sentiment has started to take a dip, and the question that we face right now is consumer sentiment going to be a leading indicator like it was pre-pandemic, or is it going to be something that doesn't really translate into actual observed behavior in the economy, that as how it played out for most of the pandemic? Right now it's an open question, and it's one of the things I'm going to be watching very closely in the months to come.
Well, it's hard to know for sure what consumers are going to do, but you talk to business leaders all the time. What's the general attitude of CEOs right now about business outlook and about their plans for, say, hiring or even raising prices?
So, we actually have started to ask our business leaders exactly this question. Where do you think pricing pressures are going to go, higher or lower? What we've heard consistently is they think they're going to go higher. Then we ask, what do they think is going to happen in terms of their sales? And they're also quite bullish on the sales rising as well, which says to me they think that consumers are going to be able to manage these higher levels of prices and whatever changes in prices that happen moving forward. We'll have to see if that actually plays out. I think that would be one of the big big questions and stories that emerges through the course of 2025, namely how the consumer manages in the face of these elevated price levels.
That's Atlanta Fed President Rahul Bostic speaking to Bloomberg's Mike McKee. Well, joining us now from Hong Kong is Ella Hoxha, Head of Fixed Income at Newton Investment Management. Ella, thanks so much for joining us today. I just want to start with those remarks from Rahul Bostic that there may just be the one rate cut in 2025. What's your outlook around this?
Well, of course, there's a lot of uncertainty in markets right now, particularly April 2nd being a very important date, which is just around the corner. We would probably say that the risks are that we get more cuts. And the reason for that is the Fed is more likely to be reactive this year rather than proactive. So just the way we've revised from 3 to 2 to now 1, as Bostic was saying, I think potentially we could go the other way around. Certainly the risks have gone up on the growth front, although the shorter-term inflation implications are more sticky, as we just heard. So we would probably err more on the side of caution and say more hikes, more cuts, I apologize, likely rather than hikes, sorry.
In terms of the stickiness of that inflation, I mean, Rahul Bostic, I mean, he sits on the Fed board. He's unsure if this is just going to be a one-time hit to prices from tariffs. What's your view of the inflationary impact of these tariff policies?
There's no doubt a hit in terms of price levels, but thinking more akin to tariffs as a bit of a VAT hike. So you get the one-off effect, and there's of course no doubt on inflationary impact from that. But in order to sustain that down the road, I think you need a series of chains of events. And so we would probably more see it as a short-term higher inflation, but down the road potentially less so, definitely in that camp.
We've seen yields ticking up ever so slightly as well. The yield on the 10-year was up about 9 basis points in the last session. Now, this is not what Scott Bessent wants. He's been saying that he wants yields lower, and he's shown some signs of taking concrete action to achieve that, limiting the size of 10-year debt auctions, looser bank regulations. Where do you see yields tracking in 2025?
We probably see more of a roller coaster environment. So we would argue perhaps over the next quarter or two that yields actually head down. And that's because of this uncertainty that we have both for consumers and for businesses. And so that should act as an anchor on yields and pull them lower. Down the road, it's a very different story. Of course, we're operating in a highly uncertain and highly unusual environment. So we don't know for sure. But I think the odds are definitely stacking in favor of yields lower. So maybe we will get what the policymakers want, which is certainly a lower yield. But I do think that's potentially going to come on the back of concerns around growth and possibly what financial markets do. So what equities do probably is even more important here. Because I sense that fixed income, or in terms of treasuries, they're following equity markets. So equity markets are very important here in terms of gauging that sentiment of what's actually happening in the real economy. So it's a little bit of the reverse of what we've been seeing over the last 3 years. It's been rates leading equities and credit. Now I think it's the reverse of that. It's almost like equities leading credit and rates.
Yeah, well, if equities are a gauge of sentiment in the economy, we've had a pretty wild ride. Do you feel that this is reflecting the uncertainty to a large degree?
Absolutely, and obviously the correction has been heaviest in the Magnificent Seven, but we have felt it across the board. But of course, a lot of dispersion. If you look cross-country, you'd probably not feel that it's a very bad setup in equities. But certainly, when it comes to U.S. equities, it's been a much softer patch. But I think it goes down to the roller coaster environment I was describing earlier for fixed income. So I think we are in that setup, and it's very much a trader's market rather than a buy and hold environment. So I do think this year it's going to pan out like that.
I'd like to get your views on Japanese bonds as well, because we've seen 10-year JGB yields creeping higher as well. And so far, Governor Ueda's not shown too much concern over this, but at the same time, he said, look, the BOJ stands ready to act if necessary. Where do you see the JGB yield tracking from here, and what's the threshold for the BOJ to do something?
Well, I would say probably at the long end of the curve, we're getting around those levels. I mean, you're getting towards 3%. I would probably say that's at best fair value. But of course, the pressure for yields has persisted. Also, there's been something that's acted as an anchoring for yields globally. JGBs and German bonds have de-anchored over the last couple of months. So that pressure is very difficult to say what stalls it. But I do think it's going to be connected to this risk sentiment in general. But I think right around here, should the BOJ intervene? Perhaps not, because we've had a healthier repricing of the curve in Japan. Certainly in the belly of the curve, the 5 to 10 year, we have still room to pressure higher. But I would say in the long end, we're probably around those levels where I would deem very difficult to see why pressure should continue from here in a significant manner.
And how about the next move for tightening from the BOJ? Is May a live one, or do you think it's going to happen later than that?
I think May is quite a tricky month, right? Because we have the Fed, and I think if we're going to get a reaction from the Fed, and if markets are going to potentially force the Fed to do something, that is likely to be the month. So perhaps the BOJ will be guided by what happens with the Fed. But as things stand, as the inflationary picture develops, and what we've seen with wage prices, they should certainly be pulling rates higher here, and that's kind of like what the market is trying to tell them. So I would probably err on the side and say yes. But of course, it depends if we get any surprises from the Fed, then that might change pretty rapidly.
Ella, before we let you go, I'd like to get your view on the dollar as well. We've got the Bloomberg dollar spot index off about 4% since its January high. Is this a trend, or do you feel that Forex markets are gripped by the same sort of uncertainty that other assets are?
I mean, I would see the dollar probably over the short term a little better supported, certainly over the next month or two. And I think the argument there is, of course, we have some clarity coming up on tariffs, but I don't think it's going to be all over on April 2nd. But also risk sentiment remains fragile, so that typically tends to support the dollar, so you have that famous dollar smile. But of course, this time could be different, so maybe we don't get that risk bid to the dollar as we've seen in the past. So it's not a high conviction call over the short term, but over the medium term, I would have more conviction to say the dollar is headed lower. And so I think that's probably something that investors can engage with down the road.
All right, Ella Hoxha, Head of Fixed Income at Newton Investment Management. Thanks so much for joining us today. Still to come, Bloomberg has learned that HSBC is weighing outsourcing some of its trading operations to help lift returns. Details of that story next. This is Bloomberg. HSBC is said to be considering outsourcing part of its trading business as executives struggle to justify making technology investments. For more on this Bloomberg scoop, let's get to Bloomberg Intelligence Senior Analyst for Australian Financials, Matt Ingram. So, Matt, what's HSBC trying to achieve by outsourcing what looks like a core business?
G'day, Paul. Yeah, it's an odd question for them to be asking. They need to find $3 billion. About half of that is transfers within the business. About half of that's cost cuts. And so I think this falls into the latter bucket, the $1.5 billion of cost cuts. Big IT spend, yes, but it's a core business. It's a strange one for me.
Yeah, so what could the consequence of this be?
So the thing about sales and trading, and particularly market making, is you know where the skeletons are buried. So when it comes time to build a book on a bond deal or an equity deal, you know who the buyers are and you know who the sellers are. And HSBC loses that visibility if they do this. Yes, they're going to cut costs, but at what expense to revenue?
And how about what brought about this aggregation of bond trading to these platforms?
It's been a particularly opaque business pretty much from day one, bond trading. A lot of it was customer to customer, over-the-counter type trading. And as we've seen that business progress into more of a on-the-screen type trading, some of it done by machines, obviously that opacity has disappeared. It's become a far more transparent business, and that's massively eaten into margins. So I guess the problem is they were earning big spreads on that business historically. They're now not, and they're asking themselves the question, does the revenue justify the cost?
Yeah, and who's picking this up? It's Citadel and Jane Street. What sort of role are they going to play here?
Yeah, so look, they're obviously going to be putting this stuff on the screen. They're going to have algorithms at the back end matching buyers and sellers. It's going to be very thin spreads. But as I said to you, once that business goes out the door, HSBC sales trader no longer knows where the buyer is. They no longer know where the seller is. So longer term, one might ask the question, are the investment bankers happy about this, for example? When they've got a big bond deal to place, who do they sell it to?
All right, Bloomberg's Matt Ingram there with a hanging question. We're going to hear exclusively later from the HSBC CEO, in fact, Georges Al-Deri, as we bring you live coverage from the bank's Global Investment Summit in Hong Kong. And in a few minutes, we will be at the summit with our first live guest, ARK Investment Management's Cathie Wood. And that is followed by an exclusive with Yum China CEO Joey Watt. More ahead. This is Bloomberg.
I don't think that there's going to be material short-term pain from the tariffs. I think the short-term pain is coming from the reorientation of the economy from the government to the private sector. Now, of course, as you know, the tariff situation is still developing.
I was at 2, I moved to 1, mainly because I think we're going to see inflation be very bumpy and not move dramatically and in a clear way to the 2% target. Because that's being pushed back, I think the appropriate path for policy is also going to have to be pushed back in getting us to that neutral level.
All right, that's Atlanta Fed President Raphael Bostic there, also hearing from President Trump advisor Stephen Marron. Let's take a look at how US futures are tracking at the moment. Kind of flat right now, but it was a very strong day for US stocks. A pretty decent rally there. The NASDAQ up by more than 2%. The Mag 7 also having a really good day. Tesla was up almost 12%, so a sharp rebound there, but it's still down about 31% year to date. So the reason for all this optimism, President Trump signaling there's going to be a more nuanced approach to April 2 tariffs, possibly some reciprocal relief for some countries as well. Let's take a look at top global headlines now. The Atlantic's top editor says he was added to a text group where US Defense Secretary Pete Hegseth shared detailed plans for bombing Houthi militants. Jeffrey Goldberg says he received a connection request via the encrypted messaging service Signal from National Security Advisor Michael Waltz. The White House spokesman says the report appears to be authentic, and they're reviewing how the journalist was added to the conversation.
I've heard I was characterized. Nobody was texting war plans, and that's all I have to say about that.
US and Russian officials have met in Saudi Arabia. This is a day after American and Ukrainian teams held talks. The discussions focused on the safety of navigation in the Black Sea and a potential maritime ceasefire with the goal of achieving a broader and permanent peace. Ukraine's ambassador to the US told us they support the US push for a full 30-day ceasefire.
We believe the idea of a full ceasefire, which President Zelensky not only commended, but again, we embraced it wholeheartedly. It's a great idea. President Trump suggested the full ceasefire for 30 days. That's a great idea, actually. That would save lives. Unfortunately, we need Russia to agree to that.
India is planning to seek an exemption from President Trump's reciprocal tariffs. Sources say officials in New Delhi are expected to make the case when the two sides meet on Tuesday for talks on a bilateral trade deal. India has already taken steps to appease the US president, including lowering imported taxes on certain goods, and is considering further concessions. The UN is asking 1/3 of its international staff based in Gaza to temporarily leave over security concerns. Hundreds of civilians, including a UN worker, were killed last week by renewed Israeli strikes in the Strip. The Israeli military, meanwhile, says it's intercepted projectiles launched from Yemen and northern Gaza in the past few hours. Got an alert on this long-running potential deal between Seven & I and Couche-Tard. Got a statement from Seven & I saying that it isn't true that they have rejected the Couche-Tard proposal. They are saying, however, that Couche-Tard refused to sign a non-disclosure agreement. Seven & I adding that it takes antitrust concerns in the United States very seriously, but reiterating that it is not true that Couche-Tard proposal has been rejected. So, yes, another incremental development in this long-running story. Let's take a look at how markets are tracking at the moment here in Australia. After coming up for 55 minutes of trade, pretty positive day at the moment. We're better to the tune of 0.2%. Pretty much every sector in the green with the exception of materials, but that sector is only off by about 0.1%. Financials having a pretty good day here, better by about 1% at the moment. Taking a look at Nikkei futures as well, setting up for a positive start to the Tuesday session there, also better by a shade over 1%. We did see Japan slipping a little bit on Monday. We're going to have Bank of Japan minutes coming out a little bit later. However, they are for the January meeting, so some interest, but perhaps limited interest there. S&P futures, as I mentioned, are currently looking kind of flat at the moment. We'll also got Korea opening at the top of the hour as well. We'll be getting some data out of Korea shortly. We've got consumer confidence numbers for March. That's seen slipping. Retail sales for the month of February coming out later as well. And keep an eye on Hyundai after it announced a $21 billion investment in the US through 2028. That's to boost its vehicle production on American soil and help it avoid President Trump's tariff plans. Still to come on the Asia trade, we're going to be crossing live to the HSBC Global Investment Summit. We'll be talking exclusively to ARC's Cathie about unlocking opportunities in Asia. We'll also have more on the Australian budget. That's tonight. We'll be joined by the Australian National University. And later, we'll be speaking exclusively to Qantas CEO Vanessa Hudson about her outlook for the carrier and the aviation industry. She'll be joining us at the Airbus Summit in Toulouse. We have market opens coming up in a moment. Seoul and Tokyo set to start trading next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. And of course, we're continuing to be on tariff watch, right? President Trump saying that auto tariffs are coming. Reciprocal duty breaks, are kind of being teased at the moment, but there's still a lot of wait and see. And in terms of the longevity of anything that's announced, too, is a question mark.
And April, too. I mean, in the context of what we've seen so far this year, it's so far away, It feels like an eternity. But on a more certain front, we do have the Australian budget coming out tonight as well. So that's going to be interesting to watch for potential election year sweetness. And
it's interesting, right? Because it's sort of federal budget. It's the same sort of conundrum that global central banks are facing. How do you deal with the unknowns, the known unknowns, I guess, when it comes to the Trump administration? How that could impact Australia's fiscal situation as well. Let's get you straight to the start of trading in Japan and Korea as that comes online. We do have the BOJ minutes from that January meeting saying that the price expectation risk there could exceed 2%. The rate is around 1%. That's desirable for the second half of the full year 2025. This is, of course, if you recall, the January meeting where they hiked. After that, they have, of course, paused in March. And one significant thing that may have changed since then is the wage hikes that we've had through the Rengo Union pay deals, as well as just expectations of further real wages continuing to improve, given that has really been a tension between sort of household confidence and inflation starting to creep up there as well. We are seeing the Nikkei 225 just coming online. a little bit sort of to the upside there. The tariff signals we're seeing create some positivity when it comes to risk sentiment today. About a 1% start to trading for the Nikkei 225. The topic's also not far behind, but 0.8%. US equities, of course, in the previous session had one of their best sessions of the year, and a lot of this sort of on hopes and expectations, perhaps, that these trade sanctions from the Trump administration might be narrow in scope, and perhaps there are sort of reciprocal avenues for relief as well. Let's head over to the Korean market, where this is the picture as we get into the start of trading for the Kospi there, up by 0.7%. We're seeing tech stocks also seeing some leadership there as well. We're watching Hyundai Motors as shares, they're rising 7.5%, as of course we did hear from President Trump hailing its US investments, and of course kind of, I guess at this point, putting it into the good books, if you will. So we are seeing a bit of a relief rally there for Hyundai Motors, and of course it has been such a difficult time when it comes to a lot of these Asian car makers, given the threat of automaker tariffs, but President Trump saying that he could give a lot of countries breaks on tariffs without being awfully specific at all.
Yeah, and that, well, relatively good news helping to float stocks here in Australia as well. We've got the ASX also showing some upside to the tune of about 0.7%. Almost every sector is in positive territory, even materials now just turning flat after having a negative start to the day. Not a lot of action on the rest of that board, though, is there? Everything else pretty much unchanged. We did see yields in the US climbing as well, and we also heard from the Fed's Rahul Bostic saying, well, look, maybe we're only going to see one rate cut in 2025, although in the broader theme of uncertainty, well, let's see how that call evolves in the coming few weeks and months. For more on markets now, let's get to Bloomberg M-Live strategist Mark Cranfield. And let's start on that tariff story. Mark, tariffs on auto imports coming in a few days, according to President Trump. Possible reciprocal breaks as well. I mean, look, do we know any more detail here, or could it all change in an instant?
I think investors are just hoping that it's not as bad as what they were expecting just a few weeks ago. So they're currently coming from the angle that they're happy to hear that the tariffs might not be on everybody. They might be diluted in some cases, and that's obviously what helped to boost the equity market overnight in the US. And it's not too surprising when you consider that US equities have gone through a pretty rough patch. For a few weeks they were being sold off pretty aggressively, so people will be underweight. They'll be looking to get back into the market to some extent, and yet we don't really know the full details of what the tariffs will look like next week. It's just that people are assuming that they can take the word of President Trump that it won't be as bad as what they were expecting recently. So that's why you're seeing a little bit of optimism creeping back into the market. That could easily change very quickly. We've seen that this is a very fluid situation. From day to day, different things are announced. Today we've had tariffs being put on Venezuela related to oil. Who knows who will get stuck with something similar tomorrow. So traders are taking a very short-term approach to that. Just because we've seen a decent bounce in Wall Street on Monday doesn't really tell you anything about what's going to happen to trading on Tuesday, depending on the next headline that hits. One of the most interesting things, as you mentioned in the run-up there, is that Mr. Bostic from the Fed is now only seeing one interest rate cut from the Federal Reserve this year. So much of the situation related to US equities is because the Fed is on a pause at the moment. They do have 2 dot plots written into their forecast for this year, but if Mr. Bostic is dialing back, that could mean that others are as well. So here you are, a situation for investors where the Fed is no longer being as supportive as they may expect for US equities. So it does tell you that any kind of bounce that you see in the very short term for US equities may not last too long. And of course, we wait to see whether or not April the 2nd really is a very serious day for tariffs across the board, or whether it's going to be heavily diluted. We have to wait and find out.
What are the expectations when it comes to China tech at the moment? Because it seems like we're seeing leaps and bounds. Of course, BYD with a big fundraising round. We're seeing Xiaomi now, that $5.5 billion upsize Hong Kong share sale as well. Does this tell us that we're seeing these companies sort of capitalize on the momentum? And I guess, are the long-term sort of positives still intact for China tech?
Well, as you say, it tells us a number of things. Obviously, clearly, investors are buying back into the Chinese tech story. They're very excited about AI developments. Otherwise, these companies wouldn't be able to raise such significant amounts. And it may well be that investors are still relatively underweight, considering that during the zero COVID period, so much money left China. People may have even actually gone short of China equities, given that they went through such a rough period as well. So not only money needs to come back in that had completely disappeared from China, they're getting excited about this AI story, and it's coming from a pretty low base as well. So not too surprising that this may well have legs, particularly if companies continue to boost decent numbers, as we saw with BYD, and we saw some of the reports last week. Earnings are pretty good in the Chinese tech sector. All of this fundraising from people like Xiaomi and BYD, also, there's a big gorilla in the background that they're all worried about is CATL. This company is one of the biggest in China, is probably going to have its earnings in the middle of April, and not too long after that, people are expecting that CATL will go for a secondary listing in Hong Kong. When they do, it will be one of the biggest IPOs ever seen in Asia. So a huge chunk of money will be sucked out of the greater China markets. So people obviously want to do their fundraising ahead of that. They want to get ahead of CATL just in case the market completely dries up by the time they approach. So you may well see other companies trying to get in this window while the market is very favourable, and they're very concerned about which next big, huge IPO may be coming to drain the market in a few weeks' time.
Mark, it's an interesting kind of environment for dollar yen at the moment, right? Particularly with those Bostic comments and just a growing divergence between what we're expecting from the Fed and from the Bank of Japan. The BOJ minutes, obviously they're quite backward looking. A lot of the data has really kind of just supported more action from the Bank of Japan to come. Where's the next kind of pain threshold for dollar yen then?
It can probably go a little bit higher in the near term. And it's very interesting that just yesterday, Governor Ueda was in front of Parliament. He sounded relatively hawkish, and yet dollar yen has still gone higher. So that tells you that the bias is shifting a little bit in the near term. Clearly, yen traders are a bit concerned about the political situation in Japan. Prime Minister Yoshida and his government here, the cabinet ratings are very low. They've just collapsed, basically, and this was not supposed to happen. Japan was supposed to put all these controversies behind it. That's why we had a new government came in last year, and yet they seem to be falling back into the same space. When you have this uncertainty in the political situation, that isn't good for the Bank of Japan. They need a clear run in terms of they need the government right behind them to say that they are fully supportive and that the yen can get stronger. That isn't happening in the short term, and traders have noticed that.
Bloomberg's Mark Cranfield there. Let's get some more on, of course, what traders are watching as an evergreen theme, those tariffs, with President Trump saying that he will announce tariffs on vehicle imports in the coming days, while also indicating that some countries will receive breaks from next week's reciprocal tariffs. Let's bring in Bloomberg senior editor Derek Wallbank. Derek, every day we kind of get more around this narrative and commentary. There's very little in the way of certainty in terms of what we know what to expect.
That's exactly right, Heidi. Look, April 2nd has been billed as Liberation Day by President Donald Trump. He has said that this is the day when the great tariffs are going to be coming. A whole wide swath of reciprocal tariffs are on the menu. More things to be rolled out at some point soon. The automobile tariffs, as you noted, but there is a lot of uncertainty over what this is going to be looking like, with now just a week away. So we're very much waiting for details from the White House, and I think we're not the only ones waiting. I think markets generally are waiting. Countries are waiting to see what the plans are for this, as well as how they might be able to negotiate their way around them. Now, one thing does appear to be clear. The initial kind of fears that this was going to be a line-by-line reciprocal tariff drawing exercise seem like that's not going to necessarily be the case. One of the reasons for that is simply a function of time. that would be a massive involvement across thousands of tariff lines and then more than 100 countries and regions, and trying to figure out who gets what and all of those sorts of things. It would just be an absolute Herculean effort that the administration does not seem to have time to be able to do within a span of a week. So we're hearing talks of this maybe being a little bit broader, more categorization based. Again, I'm speaking in fairly broad terms because the details of this are not rolled out yet. So we're waiting for those details there. But Trump has made it clear, without specifying exactly how, that there may be a path for countries to be able to limit their exposure or even to get a pass entirely.
Derek, we've got to talk about Venezuela, or Venezuelan oil more specifically. President Trump threatening any country with an additional 25% tariff if they import oil from Venezuela. Who's this going to impact the most? What's the intent behind this?
Well, Paul, the intent of this is really simple. The intent is to squeeze the government of Nicolas Maduro in Venezuela. The U.S. has had many long-standing grievances with the Maduro government in the way that it goes about life and operations in Caracas and beyond. The difficulty here is that we're going to look at a 25% tariff availability, I guess I would call it, an authorization for April 2nd. Now, I've looked into the order that the White House has issued. I've had time to read it now fairly fully, and it does have a pretty good-sized potential loophole if the White House wanted to exercise it. It allows for discretion. And that is the discretion that they may be able to put tariffs on, or they may choose not to. It's going to be Secretary of State Marco Rubio's decision, according to the plain text of the order, from April 2nd onward. But it does give the discretion to have a 25% secondary tariff. Now, I need to focus on that word secondary tariff for a quick second. What does that mean? That's a tariff in addition to anything else that may be on the menu, either implemented or threatened or promised, right? And so this gives, essentially, think of it like you would do a sanction, but it's a tariff instead. And so this is a tool of, let's say, economic statecraft that the Trump administration is putting out there. It may work as a tariff. It may also work as a threat. And that is something that the markets will have to weigh. One final thought. I noted in this executive order that the Trump administration has placed in language similar to other orders that say if they were to put this on China, if, not when, but if they were to put this on China, it would also apply not just to the mainland, but to Macau and Hong Kong as well.
Bloomberg senior editor Derek Warbank there trying to make sense of this broad sort of mural of tariff expectations. Coming up, HSBC holding its second Global Investment Summit in Hong Kong, one of the first occasions for the CEO, Georges Aldouri, to address investors. Our co-anchor David Inglis is there. I suspect there's one word that might come up today, starting with T.
Yes. Well, I'm struggling to hear you, which I guess underscores how the crowd is just starting to file in right behind me. It's one of those sort of periods right before a conference begins when you tend to see non-deliberate hovering around the coffee tables and breakfast and what have you here. So we have a ton of conversations coming up. To your point, of course, this will be the very first time we'll be speaking with the new HSBC CEO since he took, of course, the reins there of the global bank back September the 2nd of last year. And certainly one part of the conversation there will be around what they're planning to do with the simplification of the bank. So we'll get a sense really of where they are in that process, and if we can share any more information as it pertains to that exercise. Also coming up here on shows, we'll be talking about China, the Chinese economy. Ku Eugene will be joining us. You might know her, of course, the author of the new China playbook. And I'm just catching a glimpse right now of Cathie Wood. In fact, she's just here right now, just getting a bit of a touch-up before we have the conversation coming up in about, I would say, about 15 minutes from now. We're talking Tesla, we're talking BYD, and everything in between. We have a ton coming up here. Stay tuned for that. This is Bloomberg.
President Trump's top economic advisor has played down the idea of short-term damage to the U.S. economy from tariff hikes. Stephen Moran spoke to us exclusively about the administration's trade strategy.
I don't think that there's going to be material short-term pain from the tariffs. I think the short-term pain is coming from the reorientation of the economy from the government to the private sector. Now, of course, as you know, the tariff situation is still developing, and the president will decide what he wants to. The president will decide what the tariffs are on April 2nd, and has been very clear telegraphing that.
Let's talk about the tariffs. What's coming down April 2nd? The president has tasked his advisors and his team with an immense job here to come up with these tariffs for next week. What can you share about the contours of this? Should we expect country-by-country tariffs, sectoral tariffs being announced?
Sure. So, look, it's important to calculate a whole variety of things when you're thinking about when you're thinking about fair and reciprocal tariffs. Those include outright tariff rates that other countries charge us, and they also include non-tariff barriers, right? Ways that countries prevent us selling our exports into their markets through means other than tariffs, through not opening their markets, through intellectual property theft or lack of enforcement, through currency changes, through regulatory differences that prohibit our products from entering their markets. And you have to consider this entire host of things, right? And so the dimensions of analysis can get really big really fast. Now, that goes at odds with another principle, which is that simplicity is great, right? And so simplicity is a virtue when you think about these things in one sense, because it makes it more difficult for other countries to game. Now, the situation is developing. The team and the president are entertaining options. It would be wrong for me to get ahead of that, but we'll find out soon.
Stephen, the other thing that a lot of people here at Bloomberg have been talking about is this paper that you wrote in November, after elections, but before you were nominated to be CEA chair. The title of this paper was A User's Guide to Restructuring the Global Trading System, and it has caused a stir. You talk about some unorthodox policies like revaluing U.S. gold stocks, applying a user fee to treasuries, and a new global currency accord. Can you tell me how much of this is in the works now?
Yeah, so I'm glad you brought that up, because this paper seems to have taken on a life of its own against all my intents. Look, I'm pretty clear in that paper that it's a catalog of available options, and it's a recipe book, and I'm trying to evaluate how useful or not useful or easy or difficult those various recipes are to make. Some of them are easy, some are tough, some are some are filling, satisfying meals, and some will leave you hungry again in a half an hour.
U.S. Council of Economic Advisors Chairman Stephen Moran there, speaking exclusively with Bloomberg's Sahila Mohsen. You can watch us live and catch up on some of those past interviews with our interactive TV function. That's at TV Go. You can also dive into any of the securities or the Bloomberg functions we talk about, plus become part of the conversation. You can send us instant messages during our shows. This is for Bloomberg subscribers only. Do check it out. That's at TV Go. This is Bloomberg. We are watching automakers in particular when it comes to Korea and Tokyo trading in particularly closely today. We've seen that big jump when it comes to Hyundai as well. President Trump very favourable in his reaction to this $21 billion US expansion through to 2028. And of course, this coming as we have heard a little bit more commentary around what are expected when it comes to auto tariffs. President Trump saying that he'll announce these tariffs on car exports in the coming days. But potentially there are also countries that may get exemptions from next week's reciprocal tariffs as well. So there's a great deal of unknown, but as you can see, the auto space at the moment taking it as a positive. As I mentioned, Hyundai announcing plans to invest around $21 billion in the US over the next few years, and that has been received in a positive light from the Trump administration. He says it proves that tariffs work. Bloomberg Global Business Editor Karen Lee joins us now with the details. So what sort of numbers are we talking about? What's the broader plan here for Hyundai?
Yeah, well, let me share some of the numbers that are coming across the terminal. We say Hyundai investing almost $6 billion in American manufacturing. That includes a new steel plant in Louisiana that will produce over 2.7 million metric tons of steel per year. That, of course, will be great news in Louisiana, which is a Trump state. And that's part of a more than $20 billion spend, like you said, in the U.S. in the next few years. It's going to create around 14,000 jobs, and they're also planning to purchase some $3 billion in U.S. liquefied natural gas. Now, Heidi, this isn't just interesting for the U.S. It's obviously interesting for the company, and autos are particularly vulnerable to Trump's tariffs against Mexico and Canada. The industry's supply chains are deeply ingrained across North America, and this new push comes as Hyundai officially opens a new EV plant in the state of Georgia that it first announced in 2022. And the company's CEO, Jose Munoz, has long said that in the U.S., the company is going to pursue a strategy of localization to mitigate the risk of policy changes, and it looks like that's what we're seeing right now.
So what's the Trump administration saying about this, and could it help in the event of a trade war?
Well, to say that they were happy about it is probably putting it a bit mildly. Trump's celebrating the investment, of course. He's calling it a vindication of his administration's use of tariffs to pressure foreign manufacturers like Hyundai to create U.S. jobs, saying tariffs very strongly work. And he's long wanted companies to build manufacturing plants in the U.S. to avoid relying on imports. But still, Paul, it's unclear how long-lived that's going to be, what else we're going to see the president or companies do. And now in recent days, Trump officials have publicly acknowledged that the list of target countries may not be universal. It's still unclear which nations they'll target, so we'll be watching that very closely.
All right, Bloomberg's Karen Lee there. Let's get some breaking news regarding Samsung Electronics, some sad news. Samsung saying that the co-CEO, Jong-Hee, has died. He's only 63 years old. So Samsung confirming that by phone, but not giving any further details. We are hearing from Chosun Business, however, that Han died due to a heart attack. So co-CEO of Samsung Electronics, Jong-Hee, passing away at the age of 63. We're seeing a little bit of softness in the Samsung stock right now. Some other corporate news that we're tracking today. Boeing reportedly wants to withdraw from a deal with US prosecutors to plead guilty to misleading regulators before the two deadly crashes of its 737 MAX aircraft. The Wall Street Journal says the plane maker is seeking potential leniency from the Trump administration, which is reviewing many pending white-collar criminal cases. OpenAI is expanding the role of its chief operating officer, Brad Lightcap. He will now oversee day-to-day operations, including international expansion and partnerships with firms such as Microsoft and Apple. OpenAI CEO Sam Altman is shifting his focus to the technical side, including guiding research and product efforts. Heidi.
Yeah, let's take a look at how futures are in Europe opening up. This has been such a tariff news flow driven kind of sentiment flow here for this market, because in the previous session we actually saw some of that fading optimism over targeted tariffs. Now we're hearing that perhaps, we could see the relief for certain markets or certain countries from these reciprocal tariffs, as well as the expectations of auto tariff details to come. Euro Stoxx 50 futures up by about 0.1%, pretty muted there, trading in Germany as well there. This is definitely the focus when it comes to going into April 2nd, when President Trump is expected to announce these widespread levies. We did see quite a bit of movement in the sort of tariff-sensitive stocks, basic resources, for example. JP Morgan actually upgraded its position on European miners to overweight, so that was part of how we saw that upside move there as well. But certainly any expectation of a more measured, a more narrow scope when it comes to how the Trump administration plans to apply these tariffs and potentially give some tariff relief, we could see some upside going into that European trading session, as we are seeing reflected here in Asia so far. More ahead here on the Asia Trade. This is Bloomberg. Take a look at what we're watching as we see that sort of broad upside, some optimism as really we continue to see sort of the impact back and forth on these Trump tariff signals, right? Despite not a great deal of really certainty or details, but we are expecting, or at least that sort of flirtation from President Trump about the idea of reciprocal duty breaks being given to certain countries and certain markets, and perhaps an indication of that sort of the favoured reaction is what we saw when it comes to the commentary on Hyundai's investment investment in the US, and that stock is outperforming in the session so far. The Nikkei 225 up by one at about 0.25%. Potentially we get more details when it comes to the shape of auto tariffs as well. The costs be looking pretty flat at the moment. Watching Samsung in particular, of course, that heavyweight, as we heard the report about its co-CEO passing away unexpectedly. So we are seeing a little bit of a market reaction when it comes to that terribly sad news. We are seeing upside of about 0.5% when it comes to trading in Sydney. It is coming upon the budget day delivery, and we're getting more details, particularly given that, of course, this is an election year, which should also be announced shortly as well. But that balance of fiscal spending at a time when inflation is still coming back under control, Paul.
All right, it's time to take you to the HSBC Global Investment Summit in Hong Kong. Bloomberg's David Ingles is there and joined by a special guest. David.
Yeah, and we are joined by Cathie Wood. She's here with us, of course, on set here at the HSBC Summit, founder, CEO, and CIO, of course, of ARC Investment Management. Cathie, very nice to see you. Good morning. And I don't think we've met in person. I think this is the first time.
Yes, yeah. Great to meet you, David.
And I hope, and maybe we could share some of the conversation we were having right before air with some of our viewers later on, but obviously what we can talk about.
Yes.
We want to start with Tesla.
Yes.
And I'm sure you've been getting a lot of questions about the stock.
Absolutely.
Down 50%. It's recovered nicely this week. I think Elon Musk used your name when he spoke to his employees to basically tell them, hold the stock, look at the bull case, Cathie Wood has underscored. Have any of the concerns recently around the stock hold water? Do you think some of them hold water? Has your bull case changed at the margins?
Well, first I'm going to give all the credit to the 3 analysts who are working on Tesla at ARC. And no, our outlook has not changed. What is going on right now, very short term, the economy is being hit in the U.S., lots of uncertainty. That's not good for any auto manufacturer. Of course, there's the political dynamic overlay, and I know that the authorities are going after that. I think that will pass. We also have the Model Y refresh, and we understand that the orders for the Model Y refreshed are going very strongly. I won't get mine for a very long time. They have a new low-cost car coming in the second quarter, which in the United States, I think it could sell for $30,000 or less. There's pent-up demand for that. So we've got a lot of rubber bands stretching, and the most important one of all, of course, is robotaxi. And Elon has announced that Tesla will launch its robotaxi service commercially in Austin, Texas in June. That is when analysts are going to have to put into their models what a robotaxi service is. And it's a software as a service model. Right. Very high margin, 80% plus for the platform companies, whereas the electric vehicle is 15, 20, 25% gross margin. So we think that robo-taxis will account for 90% of the value of the company in 5 years. And we're on record saying we believe in 5 years the stock will hit $2,600. And that's not even including humanoid robots, which are now moving into the Tesla ecosystem much faster than even we expected. So more than a tenfold increase just from robotaxis. So.
You're not concerned over, let's call it noise, because of Elon Musk's role with the government, for example, and how that may or may have not contributed to the risk premium of the stock?
Yes, I think this is one reason the stock is down 50%. It's been cut in half. And I think this is all very short term. This is criminal activity, and this administration is cracking down on criminal activity. And oh, by the way, Tesla cars have a lot of cameras on them. So on X, we're getting to see the people who are committing these crimes, and the authorities are going after them.
Twice to say you've added to your position in Tesla this week?
We post our trades at the end of every day, so you can see that we've added to our position.
Okay. Do you think, one last question on Tesla, do you think they need to, is there any corporate action you think they should entertain right now to boost the stock? Or do you think sentiment takes care of itself?
I think these launches, the Refresh Y, the low-cost car, and robotaxi, those three, and there is one other thing, and this is more macro comment.
Sure.
We think the economy is getting hit by a lot of uncertainty. And I think a lot of people are scared for their jobs in the U.S. Anyone involved with the government, so federal, state and local, or quasi-government in the healthcare and education space, that could be as much as 30% of the labor force in the United States. And then we've got AI as another layer of uncertainty. We're seeing middle management teams actually being let go because of the productivity gains associated with AI. Their bosses can handle more and more and more over time. So that's another source of uncertainty, but we think that is going to play out positively longer term. Technology and breakthroughs in technologies are always associated with new jobs that we can't even imagine.
Right. I want to ask you now. Let me pull in the China factor here into the Tesla story. And one of the, I think, more common observations that we've heard from analysts in this part of the world is that Tesla in China as a final market currently has a somewhat inferior product compared to the competitor. Is that an argument that you buy?
Well, if you look, it depends on what you mean by inferior. So we're looking at the BYD cars, and they are fabulous in terms of, from what we can see, fit, finish, design. If you look at metrics like range and power for a given price, Tesla is still very competitive, if not the most competitive, depending on the model of car.
Right. There's nuance there.
Yes, but BYD is, from a cost point of view, moving down the consumer electronic battery cost curve, just like Tesla is. So actually, we think it's great. We think competition is great, but more important for new kinds of technologies is scaling those technologies, which both Tesla and BYD are doing. And when unit growth increases, costs come down even more. So we think Tesla and BYD are both in the lead from an EV point of view alone.
Right.
If you layer in robotaxi, of course, BYD is not seizing the moment there, at least not yet.
Okay, I know I said one last question on Tesla. You opened one door. Very quickly, worst case scenario. Let's extrapolate worst case scenario. In the event that Tesla does not do well in China, in the slightest event it doesn't, for example, and you point out, of course, that they are still very competitive there, does the bull case still hold up for Tesla if they, say, lose that market?
We do believe that China is very important to Tesla, and I actually think that Elon Musk and May Musk, his mother, are sort of ambassadors for the United States.
May Musk is a big star in China.
Yes, and rightly so. But to answer your question directly, if China were to fail, that would be a short-term hit to the stock. Would it take us away from $2,600? No, because the robotaxi story is much more a function of the Western world, where ride-hailing costs are so much higher than they are in China. We know in Wuhan, for example, Baidu's Apollo, is facing human taxi drivers that, or taxis that cost 35 cents per mile. That in the U.S., it's $2 to $4 per mile. So that's why we think the robotaxi opportunity is so much bigger outside of China.
You mentioned Baidu. You guys are nibbling.
We are.
Okay, why? Tell me why.
Well, we had a conversation very recently with Robin Li and his team, the CEO. We understand how competitive the market is in China for both autonomous mobility and large language models. But we're looking at how Robin Li is pushing the envelope. Wuhan is the toughest market in China. He can take learnings from that robotaxi experience into other markets, even just Beijing in China, and here in Hong Kong, where the pricing will be much higher. So we think he's working very hard on autonomous mobility. We believe that autonomous mobility in the next 5 to 10 years is going to scale globally to an $8 to $10 trillion market.
Okay.
If Baidu were to get any of that market, even outside of China in the rest of Asia, we think that's not at all discounted in the stock.
Okay.
Yes.
Do you see yourself adding to that position then, I would imagine?
We can never talk about what we're going to do, but you can see our trades posted every day, so we've been nibbling.
Have you entertained looking at any other name in China besides Baidu?
Oh yes, I think that the shift in even Xi Jinping's wording, common prosperity, which is still a phrase used, toward new productive forces.
Right, tech in the private sector.
Tech, efficiency, innovation. We're very impressed by what is going on in China. And of course, there was the DeepSeek moment, which for China, or it was the equivalent in China for the rest of the world, that ChatGPT was in late 22, I think.
Yeah.
So that was a big wake-up call. And one of the things we learned, so interesting, is that yes, they may have done it less expensively, maybe much less expensively. We're not quite sure about that. But the algorithm, very creative. It had not been created in the West. This is from China. It is open source. So now everyone is starting to use it. They say, we love that idea, and we're copying it. So what we've also learned and did not know until we started studying this open source movement here in China is that it really started a decade ago because a lot of software providers from the Western world were not providing their software to China out of fear of IP theft. So China said, okay, let's do it ourselves and move open source. I love open source. And I think it's going to create a lot of competition out there, which when it comes to innovation is a very good thing, especially for the end consumer.
And as an investor, there's a notion that it nullifies the US AI story because of the DeepSeek moment. I think two-part question. Do you buy that narrative? And second, the notion that a US and Chinese tech bull market cannot coexist parallel and simultaneously. Do you also have any thoughts on that?
Well, I would disagree with the latter altogether. I think innovation is thriving in both countries. It's going to be great. The competition will be great. We're going to both be better because of competition. And in terms of spoiling the AI model for Western companies, we are studying, does the model in China where you bundle the software into the hardware and the hardware is lower cost and it is all lower margin, is that going to disturb some models? Possibly. But if you look at closed source models in terms of performance versus open source models, even with R1, the closed source models are still better and we have this up on our website. What's interesting about open source, so while the closed source performance has been increasing consistently, and we've seen some breakthroughs recently, what you see from open source performance, as we're able to measure it, is the slope of the performance is actually steeper of the performance improvements. So we're very interested to see if open source is going to break into the performance territory that closed source has now, right? So
the jury's still out.
Yeah, the jury's still out. But AI, we think, is an enormous opportunity for both countries.
Quick final question for you. I can't let you go without a macro question. Outlook for the S&P 500 the next 2 quarters. Is it going to remain volatile? Are we going to retest the top, for example?
First of all, I think in the United States, we are in a much weaker economy than most investors, maybe even the Fed, understand. And that's because of what I described earlier, this seizing up by consumers saying, I don't know if I'm going to keep my job. So we think that the economy is going to be weaker, inflation is going to be much lower than many people expect, and that the administration and the Fed are going to have more degrees of freedom in the next 2 quarters than most investors think. And we think that's a recipe. We think the market's discounted all of the uncertainty. I shouldn't say all. You never say that. You never know. but a great deal of the uncertainty. And we think that the next move, and it may have just started, is understanding that this administration, from a deregulation, tax cut, and interest rate point of view, has a lot more freedom than many people now understand.
Right. Well, the bull case is not so much regulation and
deregulation
and the taxes, right? The issue for consumers is the tariff part of the conversation. And do you think they will be pragmatic in the event, of course, they pull back?
We do think they will be. These are negotiating.
Okay.
This is a negotiation on AI. I'll just end by saying,
right.
Autonomous mobility, biggest AI project in the world.
Okay.
Most profound application of AI, healthcare.
Cathie, thank you so much.
Thank you, David.
Fantastic to speak with Cathie Wood, their founder, CEO, and CIO at ARK Investment Management. Back to you guys.
David Ingles there with a great conversation. We'll be hearing exclusively more from the event with the HSBC CEO, Georges Aldery, as we bring you live coverage from the bank's Global Investment Summit in Hong Kong. This is Bloomberg.
Australia will reportedly bring forward about $6.7 billion in defence spending in today's budget to boost military capability. Defence Minister Richard Marles told media outlets the money will speed up construction of a nuclear submarine base, boost missile stockpiles and buy new ships. It's part of a previously announced $31 billion boost over a decade, which Marles says is the most significant increase since the end of World War II.
Let's bring now for some analysis out of Canberra's Jennifer Parker. She's an expert associate at the Australian National University's National Security College. Jennifer, great to have you with us. So tell us first off about sort of your expectations in terms of what the defence component of this budget will be, what it should be perhaps, and how it reflects, I guess, the changing dynamic with a traditional ally like the US, but also perhaps a more confident overtures that we're getting from Beijing.
Well, look, thanks so much for having me on, Heidi and Paul. And look, I think that there's a lot of terms thrown around when we talk about the Australian defence budget. It's historic, it's all of these things. I think we need to think about it in terms of its percentage of gross domestic product, right? As the economy has grown, how has the defence budget grown? And really, it's only about 2% of GDP. Now, the current government has increased the defence budget. They did do that last year. In terms of this budget, what are we expecting? Look, I know, and I saw in your introduction, there's been comments about a lift in forward estimates. We need to see the numbers come out, but what it actually looks like is only 1 billion Australian being moved into the last 2 years of forward estimates beyond the projections from last year. So last year, we did look like we were going to have a $10 billion Australian lift over the 4-year period. Now, that was slightly above the 2016 profile that we've been working off for a long time. So this 1 billion Australian moving into the last 2 years of the forward estimates, it's good, but it's really not enough. It's certainly money for Submarine Rotation Force West under AUKUS Pillar 1, Phase 1, and the Guided Weapons Explosive Ordnance. But I think when we step back and we talk about should we be at 2% of GDP, which we currently are, or should we be at 3% of GDP? Bear in mind, 2% of GDP right now is about $55.5 billion for defence this financial year. The question is, does Australia have the capabilities it needs to protect its vital interests in the changing region? And you mentioned that in your introduction in terms of how the region is changing. And I would say the answer is no. So it's good to see a little bit more money for defence coming forward, but it's certainly not enough.
A lot of question marks over the strength of the US alliance, right? President Trump has been, fairly sort of, it's not sort of even clear whether he knows much about the AUKUS deal when he was last asked about it. But, I also go to today's news about the leaked war plans in the Signal Group that went to one editor at a prominent media organization in the US. When you look at something like that, do you have concerns over the reliability of that relationship, the security of that traditional alliance?
Look, I think they're reporting in the last 24 hours about the use of a signal group to share information about the US plans to respond to Houthi attacks in the Red Sea. Look, I think that is clearly concerning. I think we need to let the US, though, work out how they deal with that. And I think when we think about the Australia-US alliance, we need to think about it in terms of its history. So it's over 70 years long, dates back to the ANZUS Treaty in 1951, arguably dates back to 1942 during World War II. So look, when we think about it in that, the US, in my view, is as reliable as they have always been. Australia should always be constantly looking at how do we commit, how do we contribute to that alliance. In terms of what we've seen from the new US administration, obviously we've seen significant changes in the Euro-Atlantic relationship. Some of that, though, has been signposted for quite a long time over previous administrations about US wanting Europe to spend more on defence and look after their conventional defence more. Now, that doesn't change the way it's been said by the current US administration, which, of course, gives cause for concern. But I think we need to remember that the Australia-US alliance is very different. So I'm not seeing anything right now that makes me think that the US is an unreliable ally. But I think also countries need to remember that alliances aren't always forever, and we need to be assessing how things are developing.
Jennifer, a little earlier you were giving us a rundown of where this defence spending so far is likely to be deployed. Where are the areas that you see of greatest need for Australian defence?
Look, I think there's quite a few, unfortunately, because of the limited spending in defence over the last couple of years. Australia really did take that peace dividend at the end of the Cold War. I think key priorities need to be things like infrastructure, counter UAS capability, so uncrewed aerial vehicles. We need to be looking a lot more at ballistic missile defence, which I think is certainly something that we're going to see in any future conflict as a key priority. We need to be looking also at the Navy. So in the last integrated investment program released last year by the Australian government, it cut key elements of the Navy, including mine warfare vessels and replenishment ships. So I think we need to be looking at investment in that. Additionally, guided weapons stocks. You know, the government has been big on the guided weapons explosive ordnance plan to build some capabilities here, but certainly we won't be able to build enough here. So we need to look at bolstering our stocks there.
All right, Jennifer Parker, Expert Associate at the National Security College at the Australian National University. Thanks so much for joining us. And we have more on Australia ahead every Tuesday, 11:40 a.m. If you're watching in Sydney, that's 8:40 a.m. in Hong Kong. This is Bloomberg.
Take a look at two stocks we're watching in the China session as trading begins in the next hour. Xiaomi raising $5.5 billion in their supersized Hong Kong share sale, coming off the back of course, BYD as well, that $5.6 billion fundraising. Really, we're seeing these companies building on what's shaping up to be a bumper year for Hong Kong share sales. BYD also posting pretty decent results there as well. This is Bloomberg.